Analysis indicates that the industry will increase at a compound annual growth rate of up to 20% through 2030, and other major automakers are vying with Tesla for market share. However, even while the current difficult market conditions can impede the advancement of electric vehicles, there will probably be a greater market demand for them. And at the moment, Tesla has almost 70% of the market for electric vehicles. Welcome back to Everything Tesla Stock, everyone. Tesla just released its third quarter delivery report for the year, as stated by Tesla. In comparison to earlier this year, when a closure at its China production and difficulties opening factories in Berlin and Austin limited how many vehicles it was able to get into customers' driveways, it delivered 343,830 vehicles this quarter, setting a new record. Despite delivering more cars than the previous year, the automaker's third quarter delivery total fell short of Wall Street estimates, which ranged from 358,000 to 371,000 automobiles. Additionally, there was a wider than typical discrepancy between Tesla's delivery figures and production, leading some investors to speculate that the company might be experiencing problems with demand. Similarly, Tesla's results for the same quarter fell short of Wall Street's expectations. For the third quarter, Wall Street was expecting $22 billion in revenue and $1 per share in earnings. However, Tesla revealed $21.5 billion in revenue, which was roughly $500 million less than Wall Street had predicted. Additionally, earnings were $1.05. Despite the decline in deliveries, Tesla CFO Zachary Kirkhorn stated that the company anticipates a growth rate in deliveries of slightly less than 50% by the end of the year because of an increase in cars in transportation. He also mentioned that cars in transit will be delivered to clients upon arrival at their destination in Q1, and that investors should anticipate a lag between production and deliveries in Q4. Wall Street, however, continues to maintain his delivery predictions for Tesla's Q4 at 429,000 units, implying a 43% year-over-year rise, in spite of the CFO of Tesla's admission. Will Tesla's performance be any better than this? Will Tesla's stock price rise in response to high deliveries? Continue to watch to find out. Prior to delving deeper into the video, remember to hit the like and subscribe buttons and enable notifications to stay informed about all the latest developments on Tesla. These reduced earnings and delivery numbers, along with a number of other issues, had driven down the price of Tesla's shares as many investors were concerned about a potential crash in demand for the company. Let's say that Tesla surpasses Wall Street's projections for future deliveries by around 40,000 units. Could Tesla reach 10% in a single day? The growth story of Tesla is back on track, and the problem with demand appears to be progressively improving. Tesla still appears to be on the right track with its production and deliveries, despite some analyses seeing early warning flags to the manufacturer, such as its increasingly expensive price at a time when the global economy is slowing down and forecasts for global auto sales are being scaled back. As it increases output, the automaker is predicted by Morgan Stanley analyst Adam Jonas to report good growth this year despite having handled supply chain difficulties better than many of its competitors. Although pricing and Tesla's ability to defy economic cycles need to be carefully considered, he said it would be unrealistic to assume that there is a limit to how much Tesla can raise prices without demand suffering, and that the company was not exposed to slowing macroeconomic growth. In other words, Tesla did not face an immediate demand problem. Although there are undoubtedly a number of market turbulences that could hinder Tesla's deliveries, the carmaker has actually demonstrated indications of improved delivery numbers going forward. Furthermore, if these figures increase, Tesla's stock price might quickly jump by a large amount. Despite recently falling short of Wall Street's projections, Tesla has previously outperformed similar estimates by significant amounts. Despite manufacturing issues brought on by the scarcity of microchips, Tesla recorded its most profitable quarter in 2021, exceeding Wall Street's forecast. The automaker exceeded expectations by posting total revenue of $11.958 billion in the second quarter of the year, a 98% year-over-year gain. Additionally, the company's operational income improved to $1.3 billion with an 11% operating margin, and its gross profit increased by 128% to $2.884 billion. Even still, Tesla claims that as automobile revenues increased, there was a significant increase in the number of vehicles delivered, up to $10.206 billion, or 97%. Additionally, in 2020, Chinese production as a fraction of the whole mix helped raise profit margins as Tesla topped second quarter earnings projections and generated a quarterly profit. In response, Adam Jonas lauded the quarter's profit margins, which he said were very challenging for the industry as a whole. Over the years, Tesla has demonstrated that it remains committed to the production and delivery of cars. Even though recent delivery statistics appear to be below expectations, the automaker was not in control of these circumstances. According to Tesla, its manufacturing levels are still rising. Securing vehicle transportation capacity at a fair rate during peak logistical weeks is becoming more and more difficult, though. The carmaker added that at the conclusion of the quarter, there were more cars in transit since it had started to shift to a weekly mix of vehicle manufacturing that was even more regional. These problems are thought to be small setbacks to the automaker, which it will quickly overcome. Additionally, given that the EV market is just beginning to take off, it is anticipated that demand for Tesla EVs will only increase. In the United States, the average price of an electric vehicle is approximately $67,000, which is roughly $20,000 less than the average price of record-breaking vehicles. But this is probably going to change as EV manufacturers continue to build more affordable electric cars. In the future, Hertz may serve as a key case study for the switch to electric vehicles. The vehicle rental company revealed several results regarding the depreciation of EVs and their eventual residual values during its Q2 earnings call this year. The business affirmed that, in terms of cost depreciation, maintenance, and customer happiness, its fleet of electric vehicles, which is primarily made up of Model 3 seconds, continues to operate better than anticipated. According to Hertz's comparison of EVs and cars, EVs only need between 50 and 60% of the upkeep that cars do, and the depreciation is also far lower. It also mentioned that customers are more satisfied with electric cars than with ICE cars. Even though the market for electric cars is still very tiny, there is still a lot of room for growth in this business. The company's stock, Tesla, can be a wise investment to purchase and hold based on its fundamentals. Tesla automobiles are and will remain the industry leaders. Even so, there might be bigger sales possibilities down the road. It is true that Tesla is currently trading at a premium to its historical price. The automaker's earnings are now predicted to increase 79% year over year to $4.05. Earnings for the fiscal year 2023 are predicted to increase by an additional 30% to $5.29 per share. Top-line growth is anticipated as well. Revenues are predicted to increase by 39% to $115.38 billion next year and by 54% this year. That is more than 4 times the $24.57 billion in pre-pandemic sales in 2019. While its rivals are losing money, Tesla is gaining it. The car maker is now among the world's most successful automobile manufacturers. Moreover, Tesla outperformed both BMW and Volkswagen during the quarter, with its net profit margin reaching 15%, even if its net profit margin was less than Mercedes-Benz's from July to September. Without a doubt, Tesla's profitability is a major factor in its success because it has a number of advantages over other electric vehicle manufacturers in the market. I think Tesla is still positioned for growth, particularly with its electric vehicles. The manufacturer wants to lower the price of these vehicles for electric vehicle enthusiasts around the world. One way to achieve this could be by reducing production costs, something that Tesla has already started to accomplish. With nearly no debt, Tesla is able to weather even the worst recession. The automaker is resilient enough to weather the impact of a declining economy. As Tesla has experienced similar situations in the past, the carmaker may be able to weather even the worst recessions in the future. According to analysis, there is still more demand for Tesla than it can meet. Its aggressive development strategy over the next year, which involves ramping up production at plants in Shanghai, Berlin, Austin, and Texas, is based on this fundamental premise. Is it possible for Tesla's stock to increase by 10% each day in the future? Tell us in the comments section below, and don't forget to share your Tesla valuation with us. If you're interested in learning more about Tesla's recent activities, click the next video that appears on your screen. I'll see you over there.